Imagine your money actually works. No, seriously, not perceived performance on a spreadsheet. I mean net conversion into your bank account. Right now, statistically speaking, your dollars are sitting in a savings account at 4.5%, which, after 3.1% inflation, is a real yield of approximately nothing. Or worse, you're watching a brokerage account go up on paper while generating zero deployable cash flow. That's not an asset. That's a scoreboard with no prize money. Here's the audit. Pull up your net worth. Now ask yourself, what percentage of that number is actively converting into monthly cash? If the answer is less than 5%, your capital is essentially an unpaid intern. Talented, but broke. The average American household earns $80,000 a year. They spend $77,000. That's a $3,000 annual savings rate, a 3.75% capital efficiency ratio on gross income. In engineering terms, that's a system running at 96.25% waste. You wouldn't ship that code. You wouldn't greenlight that structure. But somehow, you're living inside it. The goal of today's session isn't motivation, it's recalibration. We're going to look at 3 specific capital deployment architectures that convert a finite pool of invested money into $2,900 a month in net cash flow. Not paper gains, cash, monthly, deposited. Let's run the numbers. We aren't talking about retirement. Retirement is a 20th century industrial concept designed for factory workers who physically couldn't work past 65. You are a knowledge worker. Your depreciation curve is different. We are talking about converting your accumulated human capital into $2,900. That's $35,000 a year of latent financial capacity, enough to cover the median American's essential expenses, eliminate your burn rate anxiety, or fund a second deployment of capital entirely. Think of it as financial baseload power. Before you generate 1 watt of discretionary income, $2,900 per month is just on. Lights are on. The system is running. You can now make decisions from a position of optionality rather than survival. Spec: $35,000 per year net cash flow. Constraint: minimize capital required. Maximize conversion efficiency. Minimize human energy expenditure. 3 architectures. Let's run them in order of capital efficiency. Before we deploy, define the instruments. A dividend is not a gift. It is the company's net profit payout conversion, the fraction of free cash flow a company routes back to shareholders rather than reinvesting internally. You contributed capital. They contributed operations. The dividend is the API response. Yield is the conversion efficiency rate. A 10% yield means for every $10,000 deployed, you receive $1,000 per year in cash conversion. It's not magic. It's arithmetic. The question isn't whether dividends work. The math is definitionally correct. The question is which yield architecture gives you the highest cash flow per dollar of capital and per unit of human energy expended. The actual metric is not price appreciation, not paper gains, cash per effort. Let's apply it. Strategy 1. Covered call ETFs. Volatility compression. This is the highest conversion architecture in the current rate environment, and most people have never heard of it. That's not an accident. There's no mortgage broker commission, no property management fee, and no CNBC segment to sell you, so it flies under the radar. Here's the mechanic. A covered call ETF holds an underlying equity index, say the S&P 500 or the NASDAQ 100, and simultaneously sells call options on that index. When you sell a call option, you collect a premium upfront. That premium is distributed to shareholders as yield. You are, in effect, compressing market volatility into cash. The market's uncertainty becomes your monthly income. The ticker's doing this at scale right now: XYLD, QYLD, RYLD. These are not exotic instruments. They're ETFs. They trade like stocks. You can buy them in a standard brokerage account this afternoon. Current yields run between 11 and 13% annually, paid monthly. Now, let's do the math that the traditional financial advisory industry does not want you to do in this order. The standard 4% withdrawal rule says you need $875,000 to generate $35,000 per year. Some advisors push that number to $2 million. $2 million, sitting in index funds generating $35K a year. That is a 1.75% cash conversion rate on deployed capital. If you shipped a system with 1.75% throughput when a 10+% option existed, you'd be fired. At a blended yield of approximately 11.5%, your capital requirement to hit $35,000 is approximately $304,000. That's the range, $280,000 to $310,000. Against the $2 million conventional benchmark, you need 6.6 times less capital to generate the same cash flow. That is not a rounding error. That is a structural arbitrage between perceived financial wisdom and actual cash conversion math. Now, let's be engineers about this, not salespeople. Every architecture has failure modes. Ignoring them isn't confidence, it's negligence. Risk 1. The bull market tax. When the market runs hard, 25–30% in a year, your covered call ETF doesn't fully participate. You've sold the upside. These are cash flow instruments, not growth instruments. Deploy them only in the portion of your portfolio designated for income conversion. Risk 2. NAV erosion. High yields, but if the underlying index declines significantly, the NAV erodes. The engineering solution: reinvest 20–30% of distributions back into the position. Depreciation maintenance on a cash-generating asset. Risk 3. Tax inefficiency. These distributions are largely ordinary income. 11.5% gross may be 8.5% net after federal tax. Hold these in a tax-advantaged account wherever possible. Precision tool. Use it with precision. Strategy 2. High-yield REITs, automated real estate exposure. Let's address the elephant in the room: rental properties. The American status signal of choice for the aspirational upper middle class is the rental property. Tangible, photographable, something you can mention at a dinner party. You deploy $150,000 as a down payment on a $600,000 rental property. You take on $450,000 in debt that's 7% interest. That's $31,500 per year in interest before you pay $1 of principal. You hire a property manager. You budget for maintenance. You handle tenant disputes, vacancy periods, insurance claims, tax assessments, and the occasional 2 a.m. call about a pipe that burst in Unit 3. Your net cash-on-cash return after all of that human energy expenditure is typically 5 to 8%, and that's if you're running a tight operation. Compare that to a mortgage REIT. REITs are legally required to distribute 90% of taxable income to shareholders. Institutional scale, brokerage account, no mortgage application, no tenant screening, no toilet emergencies. Two Harbors Investment, Orchid Island Capital, yielding 10 to 13% paid monthly. At 10.8% blended, capital required is approximately $320,000. Why would you fix a toilet at 2 a.m. when you can own a fractional interest in 1 million toilets through a spreadsheet? The answer, if you're honest, is status. The rental property is a signal. The REIT is a result. The new engineer cares about results. Risk 1. Interest rate sensitivity. Mortgage REITs borrow short-term, lend long-term. When the Fed raises rates aggressively, that spread compresses. During 2022 to 2023, REIT prices dropped 30 to 50%. Orchid Island cut its dividend multiple times. This is not a footnote. This is a primary risk. Mitigation: diversified basket of 4 to 6 REITs. Never deploy REITs as your sole income architecture. Risk 2: dividend cuts are cyclical. You are being compensated for volatility. Accept that with clear eyes. Risk 3: ordinary income tax treatment. Max out your Roth IRA. Hold MER REITs there first. Highest yield, highest volatility. Real estate exposure without landlord overhead, but with interest rate overhead instead. Know what you're trading.
Strategy 3. Dividend aristocrats, the structural beams. Every well-engineered building has structural beams. You don't show them off. They aren't Instagram content. But if they fail, the building collapses. Dividend aristocrats are S&P 500 companies that have increased their dividend every single year for 25 years or more. Not just maintained, increased. Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income, Automatic Data Processing. These businesses have survived recessions, financial crises, pandemics, rate cycles, and geopolitical shocks, and still sent you a bigger check every year. Blended yields in the 6 to 7% range. At 7%, capital required is approximately $500,000. More capital, lower rate. Why include this? Because yield without durability is a structural defect. Qualified dividends from aristocrats are taxed at 0, 15, or 20% versus ordinary income rates up to 37% on REIT distributions. At a $150,000 household income, that's 15% federal on aristocrat dividends versus 22 to 24% on REIT income. The after-tax yield differential is real, and it compounds. Risk 1. Yield growth lag. Aristocrats grow dividends at 3 to 6% annually. Long-duration instrument. Deploy with a 10-year horizon minimum. Risk 2. Payout ratio creep. Screen for payout ratio below 70%. This eliminates structurally fragile aristocrats before they fail. Risk 3. Sector concentration in consumer staples and healthcare. You are not here to beat the index. You are here to generate baseload cash flow. The lowest risk, lowest yield, highest durability instrument. The rebar inside the concrete. It doesn't make headlines. It holds the building up for 30 years. You make $75 an hour. After tax, take-home is approximately $105,000 to $110,000 annually. You spend between $85,000 and $95,000 a year. That leaves $15,000 to $25,000 in annual deployable capital, if you're disciplined. At that savings rate, you'll accumulate $300,000 in 12 to 20 years. Deploy that into a covered call ETF architecture at 11.5% yield, and you begin generating $2,875 per month in cash flow. That's approximately 10 hours of your current hourly rate, automated. 10 hours of your life returned to you every week, indefinitely. Growing. The average American spends $35,000 a year on vehicles, the asset class with the most aggressive depreciation curve in consumer finance. Stop performing wealth. Build the system, then buy whatever you want with the system's output. When passive cash flow divided by monthly burn rate crosses 1.0, you are operationally free. Not rich, free. There's a difference, and most people never compute it. Here's what's actually stopping you, and it's not the math. You just watched the math. The math is simple. The math has been available for decades. What's stopping you is identity. You have spent your entire adult life being told that the measure of financial progress is accumulation of visible assets, the house, the car, the watch, the vacation. These are not wealth. These are wealth theater, and you have been a loyal audience member paying full ticket price every single month for a show that has no second act. The status system is not neutral. It is actively engineered to keep your capital flowing outward, into dealerships, into mortgage interest, into subscription services, rather than inward, into compounding income-generating positions. Every dollar you spend performing wealth is a dollar that isn't building the system that makes performance unnecessary. The people who have already built the system don't talk about it. They're not posting their brokerage screenshots. They're not at the dealership.
They are quietly collecting $2,900 a month or $8,000 a month or $22,000 a month from instruments most of their colleagues have never Googled. Their money works the Saturday morning shift. Their money works on Christmas. Their money does not take PTO. Yours is still clocked out.
The decision in front of you is not complicated. 3 things. 1. Stop allocating capital to depreciation. The car, the upgrade, the renovation that adds zero income. These are consumption masquerading as investment. 2. Open a brokerage account. Roth IRA if you qualify. Taxable account otherwise. Automate a monthly contribution. Buy XYLD. Buy a diversified MREIT basket. Screen for aristocrats with sub-70% payout ratios. Do not watch the price daily. Collect the distributions monthly. 3. Reinvest 20 to 30% of all distributions back into the position until you hit your target capital base. Then, and only then, redirect the full cash flow into your operating life. That's the entire system. It fits in 3 bullet points. It is not sexy, it does not have a logo, it does not come with a community of people who will validate your identity. It comes with one thing: a direct deposit every month that didn't require you to sell an hour of your life. The average American will hear this, feel a brief moment of clarity, and then spend $1,200 on something that depreciates. That is a documented behavioral pattern. Present bias, the tendency to overweight immediate consumption against long-term compounding. Evolution built you for it. The consumer economy refined it. Think about what that actually means. Every purchase that doesn't generate cash flow is a vote against your own optionality. Every status signal is a direct tax on your future freedom. The guy in the leased BMW isn't winning. He's paying a monthly fee to perform winning. There's a difference. And the market doesn't care about the performance. The market only counts the capital you actually deploy. So here is the real question. Not, can I do this? You just watch the math. The answer is yes. The real question is, how long are you willing to stay subscribed to the wrong system? Because every month you delay is not neutral. At 11.5% yield, $1,000 uninvested is $115 per year in cash flow that doesn't exist. That's not a philosophical loss. That's a calculable, compounding cost. The clock on your capital is always running. Either it's running for you, or it's running against you. You have the counter program now. 3 strategies: real numbers, real risks disclosed, real after-tax math. Covered call ETFs at $280,000 to $310,000. High-yield REITs at $320,000. Dividend aristocrats at $500,000. Any one of these, properly sized and positioned, starts generating base load cash flow that your current allocation strategy is leaving completely on the table. You don't need all 3 immediately. You need a starting position. 1 instrument, 1 automated contribution, 1 reinvestment rule. The system doesn't require genius. It requires consistency applied to the correct architecture. That's it. That's the entire unlock. Subscribe if you're ready to correct the system's fundamental misallocation of human capital. Every video on this channel is a diagnostic, a spec sheet, or a deployment guide. No lifestyle content, no performance, no financial entertainment. Just the math, the architecture, and the execution framework. Your capital has a conversion rate. Let's optimize it.